And earlier I spoke with Chance Finucane. He's the Chief Investment Officer at Oxbow Advisors. We touched on a number of topics, including the Fed, recession, and the markets. Great to have you back, Chance. So the last time we spoke, I asked you about whether you would see a recession this year. Now, the jobs report last week, above 500,000. Does that change your view on the outlook of a recession? And keep in mind as well, Secretary Yellen said we can avoid a recession. What do you think?
We still think that there will be a recession in 2023. That jobs report, while being a high number, there were a lot of new inputs and updates that had to get thrown into that one monthly report. So while it looked good on the headline number, I think we're going to be paying close attention to the next couple months of numbers to see if that really sustains itself. Or, for instance, the Challenger job cuts number that recently got reported was over 100,000 job cuts announced in January, which is, take away the pandemic high, that was the highest you'd seen in nearly a decade for a single month. And I think that tells us that there may be more labor weakness to come later in the year.
Do you think this report will at all change how the Fed will look at things, how they'll reassess, or what do you think they're thinking right now?
Some early comments that we've seen from Fed governors, besides Chairman Powell, seem to suggest that they're taking this as a sign that the economy is staying resilient, and therefore they are fine with keeping policy tight and raising the Fed funds rate at least another 1 or 2 times, and maybe keep it at that higher level for longer than investors would like. So we would view it as them using it as an excuse to stay tight on policy and really try to bring down inflation if the labor market is going to stay this relatively strong.
And the market's interpretation of what Powell said last time, do you think they're being optimistic, a little too optimistic? What are your thoughts?
We would say they're being too optimistic. Yeah, it's interesting. If you just look at, even say there's a soft landing and earnings do not continue to deteriorate, people are expecting $250 per share in earnings for the S&P 500 in 2024. And if you just put a typical average price to earnings ratio on that number, you would get a target for the end of 2023 of about 4,000. And that's assuming no recession, no fall off in earnings expectations. So we've already gone ahead of that, even though I think everyone's just gotten a bit ahead of themselves and getting a bit too excited, pushing back into these cyclical sectors.
Right. And I want to talk a little bit about inflation as well. Monthly CPI inflation came down in December. Core PCE actually rose a bit. Also, service inflation picked up in 2022. Do you think inflation could be more persistent, and where do you think that that could come from?
What interests us for inflation going forward, inflation continues to come down, and it will come down in the first quarter and the second quarter. But what interests us the most is some research from a group that we respect a lot, is outlining in their projections, they see inflation getting down to just 4% in the headline CPI number in the second quarter. But what people may not expect is it could stay at that level just below 4% through the rest of the year. And I think everyone's expecting that by the third quarter, fourth quarter, we could be headed back down to 2% CPI or lower. And yet, if we stay near that 4% level, just because wage growth and things like that are going to continue to keep a baseline level of inflation higher than we used to have before the pandemic, then that's going to put the Fed in a tough spot in terms of, do they want to cut rates when inflation is still hanging around that higher level?
And I would assume the Fed then would keep rates higher for longer. Which sectors do you think would be the most vulnerable?
If rates stay higher for longer, there's 2 areas that we would focus on just based off what's rallied so strongly in the last few months. So areas like consumer discretionary or tech would probably see a bit of a pullback just because you might see more economic weakness. And if rates are higher, growth stocks that are not going to deliver cash flows for a long time would likely start to weaken again. But the other area that you're starting to see a little bit of weakness in the numbers or the earnings that are being reported by the companies are more traditional cyclical areas like energy, industrials, financials, and materials, we would expect those areas, that's typically where you see late in a credit cycle when a recession kicks in, you'll see their earnings start to roll over. And while that's not the case just yet, we think that might be a bit of a weakness for them later in the year.
And these sectors that you mentioned, would that apply in the event of a recession?
Yeah, so if you just think about in a recession, financials like banks are going to have to report more provisions for loan losses, and they'll see their earnings come down. In a recession, that just means nominal GDP growth is going to slow, which is not good news for commodities businesses like energy and materials, and also usually means a slowdown in earnings for industrials. And if you look at the half of the S&P 500 that have reported their fourth quarter earnings so far, it's the energy and the industrials that are driving whatever growth there is in earnings per share for the market. But their comparisons versus last year are going to get a lot more difficult in the next couple of quarters, and we think that might lead to more deterioration in earnings numbers going forward.
And I'm looking at oil companies as well. We recently got some earnings reports, and some of them very, very good. Do you think those are outliers? What are your thoughts?
We would view that almost like they're reporting what happened in the past, and they're going off against very difficult comparisons. If you just look at the weakness in the oil price over the past 7 to 8 months, you're down, I think, somewhere between 35 or 40% in the WTI oil price from the peak in the second quarter last year. And that's going to be reflected in their earnings numbers going forward. They'll still generate a good amount of cash flow, but it's hard for energy to outperform in a recession because you are likely to see a lower and lower oil price, which is what drives their profits. We do think that in the very long term, oil will be a place that will want some exposure. But for right now, what we do own in the energy space are the most consistent cash flow generators like pipeline businesses and oil royalty businesses.
So would you recommend getting into that sector, and also keeping in mind that Biden's rhetoric is not really on oil?
We've got a little bit of exposure, but we've actually been cutting our exposure to oil over the course of the past year just because of seeing this economic slowdown and knowing that historically that's not a good environment for energy. So it's an area that we're mindful of to try and increase our exposure sometime in the future. But as of now, we think that it will still be an area of relative weakness compared to the market, and therefore we're waiting for a better entry point at some point, perhaps later this year.
All right, thank you very much. That's all for today, Chance. Oxbow Advisors, great having you on.
Thanks a lot.